indicate. Send through any questions, comments that you may have, and we'll certainly get to responding. But we begin, as I said, with a look at the property sector here in South Africa that seems to have turned the corner right about now. The sector, the best performing block on the JSE this year, surpassing returns that we have seen from bonds and cash. But to discuss how much more room property has to rally amid expectations of further cuts to interest rates, I'm joined by John Jack, CEO at Galetti Corporate Real Estate, in studio, and thanks once again for making the time.
Thanks, Ify. Yeah.
So we're told that markets are forward-looking, and a lot of what we are seeing in the share price is based on expectation of the future. And so I ask with great interest as to how much more can be expected in the rally of share prices in the property market that we've already seen so far this year being quite strong.
So if you look at Naeem Tali's report, which he put out on the 25th of September, and there at Sesfikile really does a deep dive into all of the different listed property counters. Sure. And they're calling sort of 13 to 15% annual growth on these properties. So that's total return. So growth in the value of the property, and then also dividend yield. And that's the kind of number they're talking about. What we've seen to date, though, this year has been fantastic. I mean, Sure. It's just such a good return.
Coming from a low base, of course, and perhaps maybe if you can help us contextualize the state of a lot of these property counters, the valuations at which they are currently trading at, how that compares to perhaps some of the better days, particularly prior to the COVID-19 pandemic, that offset the rate hiking cycle to begin with.
Yeah. So what you had is a derating of the whole property sector. So obviously these properties fell. Their net asset values were being written down, large vacancies, rentals trending downwards. You had large reversions, and we deal in the physical space, so the actual leasing of these properties. And what you were seeing is where properties in Sandton might have been leasing for 200 Rand a square meter, suddenly it was 150, 130, 120. And of course your costs of those properties don't move at all. And so your net values were just getting completely decimated. And so you had this derating of the property sector across the board. And that was pre-COVID. Now what we're saying is we had this huge interest rate hiking cycle, and we're starting to see that come off. Guys are calling sort of 2% over the next 2 years. So what we've seen now is this re-rating of the property sector. Still, these numbers, of course, compared to pre-COVID levels are far below. I mean, we're talking 30, 40% below where they were.
Sure.
But you've seen a significant recovery in these stocks. I mean, you've seen sort of 60%. Fortress, if you look at it from after its AB structure change, was trading at 5 Rand, now it's trading just over 20 Rand. So that's like a significant number. But, you know, you've got to look a little bit deeper there.
You mentioned Fortress, and we'll get into individual names in just a short while. But, of course, what we have seen is a re-rating of the entire stock market this year. And we are told specifically that it's the political factor and the fact that things went well that has helped with that re-rating. So maybe just talk specifically, from your opinion, the unity government, things seemingly going according to plan. How much of that has played into what we're looking at in property right now?
Sure. So I saw a brilliant table the other day which actually highlighted where we are, sort of political instability, electricity availability, water, etc. And a lot of these flags are sort of turning green. And I think just overall the business confidence in South Africa has just lifted a notch. And that always drives growth, obviously. And that number, what we look at is that GDP growth. If we start seeing real GDP growth, that means take up in the property sector, and this drives phenomenal growth for the property counter. Decreasing interest rate cycle, same thing. Cost of debt is lower, and so we see that growth coming through. So, I mean, effectively, what we're looking at now with the likes of a Fortress, for example, and with the likes of a Growthpoint, is these vacancies are getting taken up. And I think that's really where the value is coming in.
So Fortress and as well as, I believe, Growthpoint, when you talk about the vacancies being taken up, I mean, these are counters that are, or have quite a large office weighting in their portfolio, Growthpoint specifically, and there was a whole lot of question marks as to what's happening with office. And I know that office hasn't recovered to the same extent as we have seen in other portfolios or the other complexes of property. But let's talk about Fortress, up 55% so far this year. Just
incredible.
What's happening there?
Yeah. So Fortress has a very specific focus in logistics. Right. They are a diversified fund. So to put that out there, they're not, they do have a significant office component, but you've seen this tail end, you've seen this return to work, basically. So everyone's been said, even Amazon has announced recently, Amazon, one of the largest global businesses, they've said, guys, back to work. And it's coming from the global CEO.
Yeah. As from January next year.
As from January next year,
yeah. It's a 5-day working week. Yeah.
But you've seen the banks doing this, and you've seen everyone saying, okay guys, let's get back to work, you know. And what that does is it takes up that net vacancy. Overall office vacancy sitting at 13.6%. If you start talking about Growthpoint, they're doing even better. They've got a really, really prime office portfolio. And then if you look at the sort of premium grade offices, the one which we sit in at the moment, it's about 7.5%, which is really good. It's almost a structural vacancy.
So you saying, or some participants in the market saying, who have been long these property counters, that the hybrid working model is not a major risk for the sector as was before. You're expecting a strong back to your office. You're talking about Amazon, one of the bigger players globally, and you mentioned the banks, and you reckon everyone else will follow.
Absolutely. And we're seeing it already, and I think people actually want to be back at the office. The people who don't want to be at the office are highly skilled workers in very specific fields. So if you look at technology, maybe you've got engineers, you know, tech engineers and coders and developers. These guys work different hours. They don't really need to be in the office. Perhaps some engineers in the built environment, they don't really need to be in office. They actually just want to focus and do their own thing. But it's the sales guys, it's the front-facing business where you need that sort of culture and that collaboration to come through, that you're seeing those guys return to office for sure. Except
at a headline level, we do know that employment levels are at the levels that they were before the pandemic. But we also know that if you look under the unemployment bonnet, the picture does look different. And so I do know that, I mean, just based on anecdotal conversations, the people that will be going back to the office in some industries is fewer people because of the job cuts that have transpired. And basically, I'm coming back, but I need less office space from you, Growthpoint. So how are you guys interpreting what that could look like from a performance point of view?
So I think what happened is, you know, in any business, if you go and force a cash flow crisis you start optimizing your business, right? So you say, do we need all of these people? Could we be more efficient? And that's exactly what happened. Basically, they sat down and said, what does it take to actually fundamentally run this business? Which ultimately meant stronger industries, stronger businesses, because they had this inflated payroll. They don't necessarily need that. It shrunk down. But that also means they need to occupy less space. So as it is returning, we are seeing a net vacancy in the market, specifically in the sort of Gauteng region. In Cape Town and Natal, you won't believe it, but the call center market is really focusing on South Africa. You've got educated, well-spoken, and generally friendly people, people who want to help, are in these call centers. And so Natal and Cape Town has been a massive beneficiary of that, and you've got no vacancy. You've got hardly any vacancy. They need to start building office. Something you wouldn't have said 2 years ago.
Not at all. And actually, for disclaimer purposes, this building that we're in our studio, we are tenants of Redefine, as it is. And to see just how much fuller the car park is driving. Another big, as well as the consumer, of course, just in terms of the kind of retail spending that happens within these malls. But Growthpoint, we have always known in the past that tourism has worked quite well for them, particularly the foreign spend, which is being upgraded, which means what, ultimately then, as you look at Growthpoint from an earnings perspective?
Sure. Listen, the plans are incredible. If you look at it, it sort of develops out towards that sort of Granger Bay area, towards a powerboat club, and they've got, I mean, it really is a fantastic development. Now, the trick at the moment is that the development costs, and if you look through industrial, this is what's driving industrial rentals. Just the price of steel, the price of construction has gone absolutely ballistic. So what does it mean for Growthpoint? They need to now deploy their capital into an investment and achieve a return on it. The cost of building has gone up significantly, and they still need to rentalize that at the same time. So these businesses still need to make, you can't just, I mean, imagine you just build and you just put a return on it and you charge everyone 500 Rand a square meter and you think they're going to pay. They won't, because the underlying businesses still need to be there. So it's going to be, what they've done is they've allocated that capital towards growth, fantastic, and I think we're seeing it in Cape Town, capital growth, and so I think it's the right time to do it. They have the land available, it's a beautiful site, it's in high demand, it achieves some of the highest asking rentals in the country, so it is a good investment. They just need to make what they invest pay off versus their total return over the next 5-10 years.
Okay, John, just in closing, I mean, one of the other elements that we haven't spoken about is the student housing component, which Growthpoint also trying to fill. We're talking about the consumer, so the likes of Attack. In fact, we had Attack on the show, and we know what's going on with the Waterfall development and the precinct there. Things are going well. Vugile is one of those counters that are doing quite a few stuff offshore. Spain and the like. But what comes to mind in terms of the picks that I have here, just looking at the stocks that you focus on, is who's not here. So you don't have a lot of companies that are focused in the residential space. Correct me there if I'm wrong. You don't have a lot of companies also that are focused on government as a major tenant. Why?
Well, you know, I think, listen, Dean McPherson is going to be doing a lot of work in the public works sector. So the way government works is that everything gets channeled ultimately through the Department of Public Works. Dean McPherson is there now, and he has a huge plan for what he wants to do to turn around that sector.
Sure.
In fact, you've seen advertised...
Minister
of Public Works.
All right.
Yes.
Okay.
So you've actually seen advertised them employing professionals into this business. They're saying we want professionals, we want external advisory. We're looking for the private sector to work with us to turn this portfolio around. It is sprawling. It is bigger than anyone can imagine. Okay. And so in the sector, they are going to start to get these leases corrected, because what was happening is government couldn't re-sign leases, then payments were late. There's a lot of fear around government leases, and so you've seen a lot of these guys who focused on government leased buildings get devalued and downgraded, because we know what the cash flows look like. It's not like a private company. They pay their rental on time, they renew, and they give a nice long lease going forward. Government was different. Government was saying, no, we go month to month, maybe we give you a year, payments late. It wasn't a good investment.
Okay.
I think it's going to be positive going forward. So you might have actually touched on something which could be a unique investment opportunity.
Time will tell, and there'll be plenty of time, of course, to review at the end of the quarter. But John, thanks so much for joining us in studio. John Jack, CEO at Galetti Corporate Real Estate.